But both Berlin and Austin factories are gigantic money furnaces right now.
Yeah.
There should be like a giant roaring sound, which is the sound of money on fire. Okay, that's what.
Dumpster fire, right? In the
Dumpster
back.
fire.
Bigger than a dumpster. Dumpster's too small. Berlin and Austin are losing billions of dollars right now because there's a ton of expense and hardly any output.
Last quarter, Tesla reported its worst automotive gross margin in 3 years, taking a steep nosedive to 19% after multiple quarters of averaging between mid-20 and low 30% gross margins. Most investors have chalked up this margin hit to the sizable price cuts that Tesla did in Q1. To make matters worse, though, Tesla is expected to continue to have to drop prices the remainder of this year to keep up with its ambitious production goals. And so many investors are feeling like the 25 to 30% gross margins we got accustomed to for the last few years may not return for another few years. Other investors are doubting whether Tesla will ever get back to these margins, claiming Tesla will eventually have single-digit margins like every other automotive company. But one thing I rarely hear anyone talking about is the margin impact of Tesla's two newest factories, Giga Berlin and Giga Texas. After all, when Tesla achieved its highest ever gross margins over a 3-quarter stretch from Q3 of 2021 to Q1 of 2022, it was the exact time period where Giga Shanghai had almost fully ramped, but Giga Texas and Giga Berlin had yet to open. Once those factories opened, costs jumped significantly. In the clip you watched in the opening, Elon referred to Giga Berlin and Giga Texas as giant money furnaces that were burning billions of dollars. That clip was from June of 2022 in an interview with Tesla owner Silicon Valley. Less than a year later, these factories are no longer burning billions, but they are still nowhere near as profitable as they could be. In today's video, I want to show you how Giga Berlin and Giga Texas, which make up half of Tesla's 4 automotive factories, are holding back Tesla's automotive gross margins in a substantial way. And as these two factories scale to their near-term targets of 500,000 vehicles per factory per year, we will see Tesla's costs plummet. To give you some more context on the situation straight from the Tesla team, here is CFO Zach Kirkhorn from the Q1 2023 earnings call in mid-April.
Progress on vehicle cost reduction continued in Q1, with meaningful improvements on logistics and the beginnings of some commodity cost reductions starting to be realized. Per unit costs for Austin and Berlin improved as well, driven by record volumes. However, these factories still provide a margin headwind and will likely continue to do so until after we reach and stabilize at our intended volumes. And a part of the cost journey in the Austin factory is, as Drew mentioned, the 4680 cell, which is an input into our Austin COGS. As the 4680 program improves over the course of the year on cost, and then the non-cell portion of the factory improves, we see a pretty good trajectory in the Austin facility. A similar story exists in the Berlin factory. It does not have 4680 as an input, but for that factory, the journey to complete localization is still ongoing. And so over the course of this year, as volume increases, more localization occurs, we do see a good path to cost reduction in the Berlin factory as well. In existing factories too, we talk about this on every call, so I don't need to rehash it, but the expectation is that every existing factory improves all of their key metrics, and we continue to see the progress there.
Now that we have an understanding of where Tesla stands and what things have been holding them back, let's dive deep into the numbers for Berlin and Austin. We know from recent announcements on Tesla's Twitter page that both of these factories have already exceeded 5,000 cars produced per week, at least in their peak weeks. Now, 5,000 cars per week may sound like a lot, but that is only 50% of what these factories are expected to do in the near term, and less than 25% of what they will ultimately produce years from now. And we have to remember that for last quarter, the one that had the 19% gross margin, these factories didn't average anywhere near 5,000 cars per week. For Q1, Giga Texas produced a total of 43,623 Model Ys, and Giga Berlin produced 40,800 Model Ys, according to Troy Tesla's estimates. For a 13-week quarter, that averages out to 3,356 per week for Texas and 3,138 per week for Berlin, or a combined output of 6,494 Model Ys per week between the two factories. To put this into perspective, Giga Shanghai alone produces 20,000 vehicles per week, 14,000 of which are Model Ys. So Texas and Berlin were each doing less than a fifth of Shanghai's total production and less than a quarter of their Model Y production in Q1. Both factories are expected to ramp up to 10,000 Model Ys per week fairly quickly, which gets them to their initial production goal of 500,000 vehicles per factory per year. So because these factories are still largely underutilized, this is having a huge negative impact on Tesla's cost per vehicle sold and therefore its gross margins. But how do we figure out how big of an impact these ramps are having? Well, just a few years ago, Tesla was in the process of ramping Giga Shanghai, and we have the data to see how that ramp affected Tesla's gross margins over time. Specifically, we are going to look back at the time period where Giga Shanghai went from producing 5,000 cars per week to doubling their production to 10,000 cars per week. And we're going to see how that affected margins. To help us out, I'm going to be using some awesome charts from James Stevenson, who is known for his 69 tweet chart threads on his Twitter account, _enough. On the chart on screen, you will see data for Tesla's average selling prices, excluding leases and credits, as well as their cost to produce those same vehicles. Where I want you to direct your attention to is Q4 of 2020, right in the middle of the chart. This quarter is important because Giga Shanghai averaged almost exactly 5,000 cars produced per week for that quarter. This is when Fremont was doing the majority of the production and Shanghai was trying to catch up. The next quarter, they bumped up their production to 6,100 per week, then 7,500 the next quarter, and then in Q3 of 2021, they reached 9,800 vehicles produced per week in Shanghai, just under the 10,000 goal we mentioned earlier. So over a period of 4 quarters, Giga Shanghai roughly doubled their production from 5K to 10K per week, and the result was the average cost to produce their vehicles dropped by $5,100, from $41,400 to $36,300. And if we look at the same time period on another one of James's charts, again from Q4 of 2020 to Q3 of 2021, we see that Tesla's margins steadily grew from 20.7% all the way up to 28.9% over that time frame. And on this last chart, I combined James's data into one clean visual that summarizes the growth over those 4 quarters. By Giga Shanghai doubling production over a 4-quarter time frame, they were able to decrease the cost to produce each vehicle by $5,100 while increasing gross margins by 8.2%. To quote the great Stephen Mark Ryan, "This matters." And I'll be honest, when I set out to do this video, I had no idea the difference would be this huge. This thesis is further supported by data that Troy Teslike has put together on his Patreon page. Troy's Patreon is a wealth of knowledge, and I highly recommend paying for it if you don't already. Troy has incredibly detailed calculations, such as figuring out the average cost to produce each vehicle and each trim at every one of Tesla's factories. On screen, you will see a small snapshot of Troy's numbers, which is his estimated cost to produce the Model Y long range for the US, Europe, and China over the last 5 quarters. It's important to note that the US includes 2 factories, both Fremont and Texas. China just refers to Giga Shanghai. And then for Europe, the first quarter you see on screen actually refers to cars produced in Giga Shanghai that were exported to Europe. And then it's now almost exclusively the localized Giga Berlin production that you see there. When I look at these numbers, 2 big things jump out to me. The first is look at the difference in the US and Europe numbers going from the first quarter of what's listed here to the second quarter. The first quarter is prior to Texas and Berlin opening, and the next quarter is after. Notice how the cost for the Model Y in the US jumped up $10,000 per vehicle and then $28,000 per vehicle in Europe. The only reason the US didn't jump more is those numbers also include Fremont production, so that helped keep the averages down. The other thing I want you to notice is how much lower Shanghai still is for Q1 of this year compared to the US and Europe. Shanghai is $14,000 less than Troy's current estimate for Europe and $8,000 less than Troy's current estimate for the US. And I know some people will make the argument that China has the cheapest labor by far and the US and Europe will never get close to what Giga Shanghai can do. But if we look at Troy's estimates for Q1 of 2022 in the US, at that time, Troy only had a $2,000 difference between Fremont and Shanghai, meaning the vast majority of today's gap is due to Giga Texas, not Fremont. Long term, we know that Texas has the ability to learn from both Fremont and Shanghai, so we should see Texas get very close to Shanghai once it's fully ramped. And when we take a step back, these big gaps we're seeing in these numbers make a ton of sense. After all, we keep hearing about all of these things Tesla has been doing over the years to bring costs down. Things like deleting parts and processes, utilizing structural packs and gigapresses, and decreasing costs of battery components and packs. Yet if we look at James's chart, Tesla's costs per vehicle are $3,000 to $5,000 above where they were for all of 2021, so something isn't quite lining up. To me, the majority of this gap is due to the money furnaces that are still happening at Giga Berlin and Giga Texas, combined with the rise in commodity costs. That's the only reasonable explanation. I think there is a very big difference between producing 3,000 vehicles per week and 10,000 vehicles per week at these factories, and Tesla's margins are temporarily paying the price. And while I haven't heard Tesla state this outright, I think this is where they have felt so confident about giving out the massive price cuts that they have over recent months. They know that there is still a lot of economies of scale to be gained at Texas and Berlin, and they probably have another $4,000 to $5,000 to play with that most analysts aren't seeing. If this turns out to be true, I think we could see Tesla approaching its lowest production cost by Q4 of this year. So far, their best quarter was that Q3 of 2021 that we looked at earlier, where they were sitting at $36,300 per vehicle produced. Last quarter was $39,700. What's interesting is James is projecting that Tesla's cost per vehicle will basically stay the same through all of 2023, but that the average selling price will start to increase again. I'm actually predicting the opposite will happen. I think Tesla's average selling price will continue to decrease as they have to drop prices in some competitive markets like Europe. We've already seen that happening this quarter. But my guess is that we will likely see costs drop even faster than the sticker price, getting closer to the $35,000 range by the end of this year. If that occurs, then Tesla could actually lower prices on average $2,000 to $3,000 below where they were in Q1 and still get close to the mid 20% automotive gross margins again in the very near future. Here is a projection of what that could look like in Q4 of this year. If Tesla can get their production to average over $8,000 per week for Texas and Berlin, that would allow them to clear 100,000 of quarterly production in each factory. As long as the other factories continue producing at their normal rates, that would put Tesla at over 575,000 vehicles produced for Q4. With a small drop in average selling price to $46,000 per vehicle and a larger drop in average cost per vehicle to $35,000, that would allow Tesla to get back up to a 24% gross margin for the first time in a year. Now, I think the biggest rebuttal against what I'm projecting here is that no factory on Earth compares to the operational and cost efficiency of Giga Shanghai. China has some of the smartest and cheapest labor in the world, and we can't expect Texas and Berlin to match the cost structure of Shanghai. While I agree with that sentiment, I think it's important to point out that we don't need Texas and Berlin to be as cheap as Shanghai is. After all, back when Tesla reached their lowest cost of goods sold in their history, Fremont actually made up close to 50% of their production. And Model S and X, which are way more expensive to produce than 3 and Y, was 7% of the total production, not an insignificant number by any means. With all that Tesla has learned related to manufacturing over the last several years, their cost efficiency at Texas and Berlin should be way cheaper than what Fremont is. And so the smaller Fremont becomes in total production, the more likely the average cost will drop significantly. And these aren't the only costs that are expected to come down this year. Here's another clip from the earnings call with Zach, Elon, and VP of Supply Chain Karn discussing some of the other costs they expect to decline this year.
Within the world that we don't control, the two major costs there being logistics, which fortunately is moving in our favor. And I think our supply chain team has done a great job both on logistics optimization and taking advantage of reduced spot rates where they can. And then there's the commodities world, which has been a huge page point in our cost structure over the last, say, 2 years or so. And we're still kind of at the maximum of paying for commodities in our cost structure. It maxed out in the second half of last year. We did start to see in Q1 a little bit of improvement. We think there'll be a little bit more improvement in Q2.
Lithium has dropped a lot. It's worth mentioning that the price of lithium has dropped significantly.
Yeah, and that's the piece that we expect to see more impact from in Q2. And generally, as a company, we do expect commodity prices to come down and have a more meaningful impact in the second half of the year.
Depending on what time scale you're looking at, most of the car is variable. So most of the car cost is variable. And probably, if I were to guess, I think we will see improved costs from suppliers. That is our expectation.
And we're already starting to see that. Elon, I think you had mentioned before that we anticipated a crash in the lithium prices, and some of that has flowed through by way of lithium carbonate reductions into battery cost. And the same thing will happen with lithium hydroxide. The length of the supply chain matters also, because what we're talking about is very far upstream. So by the time it makes it into the battery that ends up in a car, it'll be several months. But beyond just the commodity pricing, as Zach mentioned earlier, we're also very focused on other metrics that make production very efficient. So for example, detention and demurrage, air expedites. I think our air expedites are down 90%. Detention and demurrage is down 93% from the peaks. That can be hundreds of thousands of dollars per vehicle. So we're sort of attacking all vectors and becoming very efficient.
In the chart on screen, you'll see a quick summary of all the things that will likely have an upward or downward pressure on costs over the next 12 months. On the side of things that will produce a downward pressure on Tesla's costs, we have the ramp of both Berlin and Austin and the localization of supply chains that comes with that. We have the 4680 cell ramp and the IRA battery credits. We have decreasing commodity and logistics costs, which Zach said appeared to peak in the last few quarters. And we have a lower mix of Model S and X, which will become a smaller and smaller percentage of Tesla's total production. On the opposite side, we do have some upward pressure on costs. As Texas and Berlin ramp, that means their most efficient factory in Shanghai becomes a smaller percentage of total production. It also means more Model Ys being produced in comparison to the cheaper Model 3. And Cybertruck will be added towards the end of this year and will start to hurt margins in the same way the new factories did initially. And then you still have some small effects of inflation that haven't been fully baked in, but not many. All in all, I think the deck is stacked in Tesla's favor to decrease costs significantly over the next year. My prediction is this current Q2 won't look too much different from Q1, as Berlin and Austin still weigh down costs, and it looks like Giga Shanghai is in the process of refreshing the Model 3. But then as we get into Q3 and Q4, I expect costs to drop off a cliff. Then it will be off to the races in 2024. But I'm curious to hear your thoughts. Do you think the ramp of Texas and Berlin will have a similar effect on costs and margins as the Shanghai ramp did years ago? Do you think Tesla will be able to beat their lowest cost per vehicle produced prior to their cheaper next-gen vehicle coming out? Let me know in the comments below. And if you enjoyed today's video, please like, subscribe, and comment below. Thank you for watching.